Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our downside when we think we need to. We think we're getting close to having one of those gut wrenching reality check sort of corrections in the overall market. I've got some good data points. I'm going to walk you through those, but it's a little disturbing. And then looking at the long term chart, where are we with the overall advance in the overall markets? And I think that'll kind of prove our point. So the stock market bottom up fundamentals. We had three companies report last Thursday. I think that was a good reality check as to what's the real fundamentals in the market and what are we paying for them. And the market cannot support itself on those fundamentals. So Costco reported, everybody loves Costco, right? It's been the darling of Wall Street. Every portfolio manager in America shops at Costco. Everybody likes it. They had 5.7% revenue growth. So a stock that trades at 44, 45 times earnings, having 5.7% revenue growth, just doesn't make a whole lot of sense. So at 45 times earnings, and only growing 12%, you would expect 2x, maybe even 3x sort of growth in what they're reporting. So I know everybody loves Costco. It's a great place to shop, but the stock just doesn't make any sense anymore. The stock could trade back to kind of a normal valuation where it had traded for many years around 27 times, or maybe it's 30 or 35 times, but 44, 45 times makes no sense. Now, Marvell and Broadcom reported earnings as well, and Marvell had a 50% drop in one of their semiconductor lines, and most of their semiconductor lines as well. Their AI business performed well, and that helped things out. Same way with Broadcom. Broadcom had one of their semiconductor lines down 30%. Those are recessionary type of declines. This smacks you in the face of, wow, what's going on here? I remember back in 1990 when Caterpillar Tractor reported earnings. It was July of 1990, and I knew for sure we were going into a recession, and later that year we did. You could just see it in the company reports. So these are data points. These aren't to confirm anything, but likely we're going to get a correction as more companies report these type of disappointments. It's clear that AI is a big positive for the economy and for particular stocks in the stock market, but it's early and it's not been really well delivered at this point. So what we see in the semiconductor space is like NVIDIA. NVIDIA's lead times. So this is a really important factor for semiconductor companies. So when lead times shrink, it means demand is also slowing down. So NVIDIA's lead times were about 11 months. I believe they're somewhere around 3 to 4 months currently. So you can get those parts a lot quicker than what companies anticipated. I believe what was happening, they were double, triple ordering those parts so they could get a bigger allocation. Likely, those aren't real, and some of those orders are being canceled, and supply demand is coming more in balance. The reality check clearly on Marvell. I think Marvell might be a short. You can see the big decline it had in the stock on Friday. It could continue to go down as all of the other two stocks did on Monday. Again, the stock got way overvalued. There's not enough there to support it. The stock market at 21 times earnings is vulnerable. Broadcom looks actually kind of good relative to the other semiconductor companies in terms of valuation. 29 times earnings. I can't believe I'm saying it looks good. It usually trades around 15 times. They bought a lot of slower growing companies over the years. It's a roll up company. At 29 times, they need to deliver, and maybe later in the year they will. But this is a problem for the overall stock market. We're going to see more companies report these type of earnings as the base business just is not good because the global economies have weakened up. there might be an inventory issue as well in the semiconductor space, and we kind of went through that in 2022. The stock market technicals. So, at times we need to go back and look at the long-term trend. The short-term probably doesn't give us a lot of information, but the long-term certainly does. This comes from a technician that I follow. I created his chart. It comes out a little bit different for me. I always like to prove things out to myself. You can see this is a 30-year chart. You can see the high here in 2000. It punctured above the long-term trend. It did the same thing at the end of 22, early 2023, popped above that long-term upper end of the channel. So as it goes through the upper end of a channel, that's concerning. So it's done it again. So we're above the upper end of that channel. Keep in mind, there's some really good performance through here. So the bottom end of the channel is roughly 3,000 on the S&P, and we're over 5,100. The midpoint is in the low 4,000 range, with the 200-day moving average at around 4,500. So we're thinking likely there's downside to that 4,500 level, which is over a 10% pullback in the overall market. So the markets are highly valued, as we've mentioned over and over again, at 21 times versus 24 in 2000, which we thought was very excessive, and we'll never see that again. We're not far from there. The sentiment's still bullish, and there's obviously a number of other things that are concerning. We're keeping our eye on the unemployment rate. As the unemployment rate ticks higher, the consumer will probably weaken from where they are currently spending, and maybe roll over into recession later this year. So on the short term, there's risk in the overall market. So we always focus on what the distance is from where the market is currently after a multiple year run, what the distance is from the current market price to the 200-day. So obviously, if you do it just coming out of a bear market, it doesn't mean a whole lot to be above the 200-day. But after a big move followed by another big move, then it makes more sense. Now we're fairly far along in this current move. Big performance from the bottom in November. We're a distance away from the 200-day, 12.5 to 13% above the 200-day. That's quite a drop. Just to get down to 200-day, that's a nice correction in the overall market. We would point out you want to be a little bit defensive through here, or maybe if you really like your money, maybe you're even more defensive. Catalyst for decline. I don't really see really a big catalyst other than interest rates staying higher, inflation being more sticky. It causes the Fed to maintain their tightening bias and the unemployment rate to start to tick up. Seeing things like Costco and Broadcom and Marvell are concerning. So we think the unemployment rate is the thing to really watch, and initial claims when they come out on a weekly basis, look at those. If initial claims go above 260,000, that's a good sign we're probably in a recession. They're down around the 220,000 currently. And the unemployment rate last month went up to 3.9 from 3.7 in January, up from a low of 3.4. If you look at this chart, there's no doubt about it what direction the unemployment rate is going to go. It's going to go higher. So we're seeing signs that companies are shorting. They're bringing down the average work week for their employees, and they're not laying people off yet. So employees are working less, and if the economic trends weaken up, you're going to see layoffs start to occur, and then you're probably going to see a recession. The CPI is probably after you watch this video or read Mark in a minute, will be out. The market expectations is 3 to 4%. We think it could be maybe slightly lower. The issue is the labor. So wages are hanging in there nicely. So people are getting getting wage increases. Inflation is pulled back below what the trend of the wage prices are, but it's getting a little sticky. We think there's some inertia on the downside. It's going to be harder and harder to push this inflation now without the wages coming down as well. The gasoline prices, oil prices, they're lower than what they were about a year ago. You can see a year ago they were about $2.80. We're about $2.50. So that's a nice trend for CPI to come down. We're watching that to see if the oil prices / gasoline prices tick up, but right now that should benefit CPI. So not overly concerned about CPI. However, it's probably going to stay elevated longer than the market expects because of the wage inflation. So in terms of wealth management, what to do? So as we mentioned, in prior market minutes, we think it's prudent to have some dry powder. I manage a overall philosophy at my firm called loss averse investing. What does that mean exactly? It means I like to buy low and I like to sell high. So the charts we showed you are obviously high. We are in the high part where you should be taking profits. Secure some of those gains. So if we don't manage your money, what you should do is go through your portfolio and sell the stuff that you're least comfortable with, or take some profits in the stocks that have done really well. Get some dry powder, because I think it's highly likely we're going to see a nice pullback here in the short term. We could see a rotation, so it's always possible for the market to rotate, and we are very positive on the small cap space if that would occur. So if the Fed cuts rates and the market begins to rotate, the cyclicals pick up, there could be a really nice rally left in this market. However, we think that it's more likely the Fed to stand pat and bring down rates a lot slower than what the market needs for it to happen. So technically we're overbought. Long term, it's a little concerning how much we're overbought. Valuations are high. Be a loss averse investor. Protect yourself and take some profits. If we manage your money, just be assured that we are set up to protect the portfolios in a bear market. So thank you very much. Please subscribe to our channel. Come to my website, Patrick M. CFA. Sign up for a hard copy of Market in a Minute, and we'll deliver it to you via email every week. Take care.